Hi guys, I'm just going to give you a few seconds to enter the room and we'll get this started. Okay, great. So look, welcome. It's a pleasure to be here, and it's great to see that we are growing as a trading community. So look, first and foremost, on behalf of me and the FP Markets team, I want to extend my thanks to all those who've joined this evening. I really hope we're able to walk away from here a more informed. I really hope we're able to walk away from here more informed, educated traders. Look, by way of an introduction, my name's Aaron Hill, and I'm one of the technical analysts here at FP Markets. I've been involved in the financial markets for more than 12 years now. Look, so I hope I can be of some help this evening. So any questions, please do let me know. If I'm unable to get through all of the questions this evening, please do consider sending your questions to either Market Analyst at fpmarkets.com or support team at fpmarkets.com. Yeah, and we'll get this underway. So look, I assume I'm coming across loud and clear and everything's working. If not, please do let me know and we'll see what we can do. All right, great. So look, quick disclaimer, trade responsibly, guys. Derivative products are highly leveraged, carry a high level of risk, and are not suitable for all investors. Features of our products, including fees and changes, are outlined in the relevant legal documents available on our website. Excuse me. So look, let's get started. Right, so on the agenda this evening, as you can see, the main motivation is regarding a trading plan, right? So it's to define what a trading plan is and what it is not. Understanding the components that make up a trading plan. At the end, we'll look at answering any questions you may have, and yeah, we'll see how this goes. So, look, what is a trading plan? I think it's first easier to highlight what a trading plan is not. So, a trading plan is not a few notes scribbled down on the back of an envelope. A trading plan is not simply your trading method. This is often confused. And a trading plan does not guarantee success, but it certainly helps tip the scales in your favor. A trading plan, in simplest terms, is a comprehensive gathering of rules and guidelines that governs each part of your trading routine. So here we go. Who needs a trading plan? So look, if you've been a consistently profitable trader over a sufficient length of time and have ingrained your trading plan to memory, you will not really need to be checking the trading plan, but you will certainly have one because it's so well fixed to your memory at this point. But I'm sure most of us here do require a trading plan. Without it, you are literally driving blind with no lights down a dark street, if you will. The point is, we all need a trading plan. Now, some people have described a trading plan as I would say, a map designed to get you from A to B as safely as possible. Point B being the destination, as in consistency. Point A being the start of your journey. So think of this as your account deposit and a clear trade log. Think about it like this. Would you drive across your country without a map or your GPS switched on? For most of us, we would not even think about driving without this, right? It would lead us to unknown destinations and may even lead us to breaking down through lack of fuel. So why on earth would we think we can safely navigate the markets without a roadmap? Running out of fuel in our driving experience is akin to, consistent losses. So our car or trading account has not broken down. It's just temporarily stalled, if you will. So the main point is, like we use our GPS to drive, we must use a trading plan to govern direction in our trading and investing. This is a super important slide. So is there a difference between a trading plan and a trading strategy? New traders must understand that there is a difference between the trading plan and the trading strategy. Now, a trading plan, as I already alluded to, is a complete arrangement of rules governing your trading process. It should be reasonably detailed, and it is within the overall trading plan lies your trading strategy or trading strategies, which is your entry and exit guidelines. So to be clear, a trading plan really incorporates all of your trading life, while the trading strategy or system forms one element of the overall trading plan. So you can think about it like this. We have a notepad and we have 12 pages in the notepad. Those 12 pages are dedicated to your trading plan, your overall trading plan, but 2 pages are dedicated to your trading system's rules of engagement. The other 10 pages are designed for risk and money management and things like goals and things you want to achieve by trading. By this point, I hope we're all on the same page. Namely that we should all be working with a trading plan. So really, what will a trading plan do for us? So a trading plan will make the act of trading much simpler. It would give you a simpler trading life than you would have without trading with one. It will limit the mistakes. It will limit your opportunity to make bad trades, and it will prevent many psychological issues from taking root. Most importantly, if your trading is going badly, if trading is poor with a trading, so look, what about if trading is poor with a trading plan? So if your trading is going badly and you will know it is down to one of only 2 possibilities, either something in the plan is not working or you are not adhering to the plan. If the plan is a good one and it is back tested and paper traded or forward tested with a small amount of money, then the fault is likely to be found with you not respecting your plan. But what if you're losing money whilst trading without a plan? It's virtually impossible to distinguish what you are doing right from what you are doing wrong. This is how important it is to work with a trading plan. Performance evaluation. So a trading plan can act as your personal GPS, as we've already discussed, right? A GPS device to locate your position, and if you've made a wrong turn, it provides you with the means to identify where you went wrong and how to get back on track. So with a trading plan, the performance evaluation, you're able to evaluate your results with a trading plan, and more importantly, your discipline in a manner that is objective. In a manner, sorry, let me repeat that. So you're able to evaluate your results with a trading plan, and more importantly, your discipline in a manner that is objective and comprehensive, right? So this is extremely difficult to do if you do not have a trading plan. A trading plan aids decision making, right? So if you think about it like this, a trading plan should take away much of the decision making. All the decisions have been made. They're all clearly written in your trading plan. Your trading strategies are all clearly defined. So emotional issues as I'm sure you're all aware, emotional issues will become very powerful once real money is on the line, and potentially can force you into making irrational decisions. So with the correct trading plan, your every action should be spelled out so that in the heat of the moment, if you will, you do not have to make any decisions. So you will just follow what the trading plan stipulates. It's very boring, but it's what professional traders do. So a trading plan, just to recap, can offer you a simpler trading life. It can limit your mistakes. It can tell you where you're going wrong. Performance evaluation, kind of the same thing, these two. And it can aid decision making. It should, as I said, it should really take out the decisions for you if you have a trading plan. So with everything said so far, we would rather be this person over this guy here, right? I'm pretty sure we can all agree on that. This guy looks incredibly stressed and incredibly tired with life. Very confused. This guy looks a bit more chilled. Very, very cool setup. And so we all this is our goal, right? We all want to be this guy, assuming he's consistent, of course. Look, before we get into the nuts and bolts of some of the components in a trading plan, a few points I really, really want to highlight. Just bear with me. So a few points I really want to highlight are what a plan is. Just bear with me, guys. So with a plan, you are likely to lead a simpler life, as we already discussed, right? So with a plan, we are likely to have a simpler trading life. With a plan, you can monitor your progress. This would, of course, be helped by a trading journal, which for me should be included within your overall trading plan. A plan also helps to prevent many psychological issues from developing. We all suffer from psychological issues within trading. I'm pretty sure most of us do, unless we're not human. A trading plan will also reduce the number of bad trades, assuming the plan is respected. It will help prevent irrational decisions. Again, this really stems from the emotional component, right? A plan enables you to control the only thing you can control, and that is yourself. You cannot control the market as much as we feel we can with our trading strategies. We cannot. Every trade, every time you put a trade in the market, the result is random. It's only over a sample of trades, only over a considerable sample that you will start to see your edge playing out. So every individual trade is random. Professional traders are highly disciplined, right? So a plan will instill a large measure of discipline in your trading. Gamblers tend to lack discipline and certainly lack a plan. They're either on red or black, right? So a plan will enable you to trade outside your comfort zone as well, but trading outside your comfort zone in a structured manner. How many times have you let a loss run and cut a profit short because it was the comfortable thing to do? So a plan executed with discipline will help avoid this from happening. Guys, when I say that a plan should be adhered to, I actually do mean it. I know how difficult it is, even though you've spent the time objectively defining your trading plan. It's still very hard to follow, right? Very, very difficult sometimes to follow. And I understand this. I've been there. But trading will eventually, assuming you do reach a form of a level of consistency, will become an actual boring task. All you're doing is you're looking for your setup, you're ensuring all the parameters, all the ducks are lining up, and pulling the trigger. You have a loss, so be it. You move on. As long as risk is contained, you move on, and it's the next trade. A plan, as I've said, is quite simply, your roadmap, which will enable you to get from wherever you are now to wherever you want to be, which I assume is consistent profitability. Okay, so look, this is where we get into the nuts and bolts. To kick things off, there's a few questions you must really ask yourself, which I believe should be written in your trading plan on the first page. Why do you want to be a trader, and what are your primary goals in trading? So are you certain that trading is the right business for you? If you believe the markets exist to provide you an ATM machine after taking a weekend course, then I'm sorry, you're going to have to think again. Consistent trading can take years of dedication to reach a level where you can comfortably rely on your trading. So you have to be prepared for the long haul, guys. It's not something you're going to learn in a couple of weeks or a couple of months, and it is certainly something you have to be passionate about to have the willpower to continue. So do you have plans to become a full-time trader, right? So here, question yourself, what are your primary goals? Do you have plans to become a full-time trader, a part-time trader, or how will this improve your quality of life? These are the questions. Sorry, guys. These are the questions we must all honestly confront and answer. So also, in terms of goals, you will need to consider your annual goals, your monthly goals, weekly, and sometimes even daily trading goals. For me, guys, I rarely set daily or even weekly goals. I'm just not comfortable operating that way. I prefer to give myself some breathing space and actually set quarterly goals alongside my yearly goals. These may not, also the goals may not just be financial, right? They may be to improve your discipline in adhering to your trading method. It could also be to read more books. What trading style would you prefer? So look, are you a discretionary trader or a non-discretionary trader? Do you trade with algorithms, for example? Do you propose to trade in the long term, i.e. months, medium term, i.e. weeks, short term, i.e. days, or even intraday, so day trading or scalping. So that's all trades and normally close before the day's end. The choice of position trader, swing trader, or day trader will, to a large extent, be determined by the amount of time you're able to devote to this business. Generally speaking, look, day traders, they remain glued to their monitors throughout the duration of every trade, right? So for the most part, while position traders may devote as little as 1 hour a week to the market. So position trading is more of an investment style. So it's very, very important that you define your primary goals and define your trading style. So another key note for your trading plan is certainly, what are you actually going to trade? For me personally, I've only really ever traded currencies. I did dabble in the options market in my early days. I used to short options, write options, but look, I've largely stuck with currencies. Most professional traders I know tend to restrict their focus to a limited number of markets and instruments to gain a more fuller understanding. On the other side of the field, you have novice traders that tend to trade equity indexes one day, exotic currencies the next, gold the next day, and Bitcoin the subsequent day. So I'm certainly not here to say that you're wrong if you do this, but the general consensus that I've found is the more experienced traders work with only a few markets. They really, really understand and get to grips with the market. So like currencies or commodities, for example. So another decision, of course, is which time frame will you trade? This will obviously be decided through which trading style you adopt. If you trade short term, you will likely be working with lower time frames, such as the 5-minute charts, then maybe the 15-minute chart. This would be for a day trader or, a scalper, I'm guessing you could say. Swing traders tend to focus on the more H1 or H4 and sometimes daily time frames. Above this, we're then looking at position trading. So above the daily time frame to the weekly time frame and monthly time frames is more position trading. So you may also elect to work with a multi-time frame approach, and this is what I personally prefer. Okay, so now we're on to tools of the trade. Now you may think that this is a waste of time applying this to your trading plan, but I would really recommend this. So in this point of your trading plan, you would list things like the brokerage you trade with, and more importantly, all of their contact details. There is nothing worse than having an issue with a trade and not having the relevant contact details immediately. This is the phone number, this is the email address, and things like that. So, and with this, of course, you will need to note which platform you'll be working with. For me, it's imperative that you are familiar with both the broker and the trading platform before going live. That is, investing with live money, real money. This includes being familiar with the broker's order types and, of course, their business model as well. This will lead you onto the data feed, of course. With FP Markets data, I believe it's free of charge with MT4 and MT5 in various markets. Okay, next up, daily routine. Right, we're all different. We all have different commitments, and so this will differ. This will be different for all of us. The daily routine should be clearly noted in your trading plan. Do we need to check yesterday's trades, assuming you're an intraday trader? Do we need to assess the current position of active trades? Remember, if your trading plan states not to hold positions overnight, this would mean you're a day trader or scalper. Then do not break this rule. Close trades, assuming you're trading at FX, of course, before 5 p.m. Eastern Standard Time. Will we assess current market conditions? So prior to our trading, how do we assess the current market conditions? Are we looking at equity index futures? So to gauge risk sentiment. So are we risk on or are we risk off? What are cash equity markets doing if they're open? You can usually use the major equity markets to gauge risk sentiment. You can also check bond markets, so check where the US Treasury yields are. If we're higher across the curve, we know traders are selling bonds, which is generally considered a risk-on trading environment. Check the US dollar index, right? The US dollar is a well-known safe haven currency. Even today, we've seen the dollar index rise because on the back of demand for safe haven, on the back of safe haven demand, even though US consumer confidence came in incredibly, so much lower than expected. So we can also check economic indicators, right? And are there any major news stories that must be taken into account? All of this must be noted in your daily checklist, your daily routine. Also, guys, work with a watch list, right? Have those markets of interest clearly noted. So if you're looking at the euro dollar, have it noted, so you know where you are every single time you come to your screen. So risk and Look, as I'm sure you can imagine, risk and money management methods must be included within the overall trading plan. Unfortunately, look, guys, I get it. We all love to work with charts, but risk and money management methods must be included. This should not be overlooked. Failure to apply sound risk management principles will almost certainly lead to financial ruin in trading. Risk management focuses on steps necessary to minimize losses by assessing, the market conditions, risk reward, probability, and the use of stop loss orders, for example. Now, money management focuses more on the steps necessary to maximize profits by adjusting the position size, right? I've always found that, especially for retail traders like us, risk and money management are pretty much fall under the same umbrella, right? So if you risk 2%, your position size should accommodate that. So I believe they all fall under the same umbrella for us. Look, we all have a different attitude to risk, and therefore we will all have slightly different trading plans. Now, risk management. Look, points you will want to include within your risk management plan are your risk tolerance on each trade. Now, this will be different for all, despite the rule of thumb saying risk no more than 2%. Now, guys, if you have risk appetite, if you're a risk taker, you may be comfortable risking 3% or 4% of your account. Those that are not comfortable with 2%, they may risk 0.5% of their account or 1% of their account. Hardware risk. Now, this may seem a bit odd, but hear me out. If your computer crashes and you have active trades open, what would you do? What would you do? What's your plan? This can happen, guys. This really can. If there's a storm and you're in a trade, what do? You must have this scenario detailed in the event of its occurrence. As I've said already, have the contact details of your broker written down at your trading desk, as well as within your trading plan. Have a backup laptop even. Many traders I know even have backup generators. They are relatively small. You can find them on Amazon. And, I think they're battery powered as well, but they will get the job done if the electricity is cut. Some traders also know have 2 internet connections. These are the larger traders with relatively big accounts. So if you've got, a position, imagine if you had a position with the risk being $10,000 US, that's your risk on one trade. It's worth having another internet connection, right? It pays to be prepared, right? So next on the menu, of course, is reward to risk, the assessment of reward and risk. Now, the rule of thumb for many appears to be 2 to 1, 2 being the reward and 1 being your risk. And assuming your winning percentage, that is your winning trades over your losing trades, is at least 40%, then you will earn money over the long haul. It's just like I said at the beginning. Each trade is random, guys, but if you work with a sample of just off the cuff, 100 trades, there you will see your edge playing out. So if your winning percentage is 40%, you will see 40 of those trades will likely win and give you, on average, maybe a 2 to 1 reward to risk ratio. Now, it's important to understand there is little point in having a strategy that wins 90% of the time, but only delivers a small value when compared to risk. For example, if we win 9 trades out of 10, so that's a 90% win percentage, but we only win $10 on those trades and $10 on the winning trades and lose, say, $200 on the 10th trade. Well, we are then going to, it's not going to end favorably for us. The key point here is we must address reward and risk in your trading plan. How do we generate this reward to risk range? Quite simply, guys, we can determine the a reward risk profile through backtesting, which is a must for all trading approaches. Okay, next up, protective stop loss orders, right? So how will protective stop loss orders be placed? While this will be detailed in the trading strategy, where you place your stop loss and things like that, is it a technical based stop? Is it a money stop? It is important to note that this in the risk management folder. I would strongly recommend all traders employ a stop in their trading if it is there to help. It's there to help limit the potentially devastating loss in your account, which is known as account ruin. So our equity. So if you imagine our equity is brought down to a level we would find it very difficult to recover from. And guys, this really can happen. The markets can turn really rapid and really fast, and they can move our positions within a heartbeat. I feel much better being protected as best as we can. Obviously, price can jump through our stop loss. I get that, but I feel a lot more comfortable knowing I have a stop in the market, which will surely get me out of the market quicker than I would in a fast-moving market. So, when to stop trading? The final point: when to stop trading. So, look, this is good risk management and will vary between traders. Like, I'm talking to you guys here. Do you get frustrated after 2 consecutive losses in a day? Now, this could be your threshold, right? To stop trading and shut down the computer. We know, right? We know how difficult it is to stop trading. If you think about this, when you have a loss, so you have 2 consecutive losses, your mindset, the majority of people, their mindset is get back in the market. I need that money back. I want it returned. So it's a revenge. It's revenge trading, right? So you're back in the market and you're not in good shape to be taking higher probability setups. So you're going to take lower probability setups and the cycle will continue. And then you'll lose more money, and your day will end very, very badly for you. Now, this may surprise you, but those that win, say you win $1,000 on a trade. This is just a value I've just thought of. You win $1,000. You're very, very unlikely to jump back in the market. The majority of people, because they do not want to lose that money that they've made on the day. They're fearful of losing that money. So, this risk, when to stop trading, really only applies to those that have trouble staying out of the market after a few consecutive losses. And look, if you're disciplined enough and you win, say, $1,000 and you're disciplined enough to continue, then by all means continue. We all differ, right? And our trading plans has to accommodate. They have to accommodate that. To our own personality, if you will. So every single trading day should end in one of 3 ways, namely, 1, on a winning day, you have a very simple rule for stopping trading once you've reached your target. 2, on a losing day, you have a daily stop and cease trading as soon as it's hit. Daily stop might be $200. Number 3, some days there are just not any trading opportunities to be had, so you had no trade at all. Sometimes it's best to remain flat, guys. Okay, money management. Right, first and foremost, your trading capital. First point here, your trading capital must be money that look, I feel even silly saying this, but your money, you should only be working with money you can afford to lose and that's set aside from everyday expenses. This is common sense. If you lost your entire account on a black swan event, think of back in 2015 when the Swiss bank unpegged the euro from the Swiss franc from the euro. If you was on the wrong side of that, that's your account gone. And this should make no difference to your standard of living. So clearly define in your trading plan to the extent to which you will credit additional funds to your account in the event of a large drawdown, and obviously debit the account when it starts to provide returns. Lock profits. How will you lock in profits? So look, this is the second point. How will you lock in profits? I guess this could fall under the umbrella of trade management. But for me, locking in profits is incredibly important. And I've said this in a number of webinars now. It really gets to me when I read traders saying that winners will take care of themselves. Look, I have no idea how they're doing this, because a winner does not take care of itself. You still need to manage your trade. We need to manage these positions and combat the emotional challenges that come with this. Many will utilize a trading stop in this scenario, which is fine, and that almost does really take the majority of the psychological elements out of the decisions, right? Because once the trading stop is hit, that's it, you're done, you're out of the market. Again, guys, this will be trader subjective, right? How you apply, how you lock in your profits. So how will you determine position size? This is the third one here, guys. How will you determine position size? So the size of your position should never exceed the parameters specified in your risk management rules. I've said this already, and I really need to push this home because it's incredibly important. So the topic of risk management, the topic of money management can appear quite dull to many traders. I've noticed over the years that many prefer to concentrate their efforts on method development. Look, albeit still crucial, we must adopt a well-rounded skill set if we want to be successful traders. So taking on board risk and money management principles, it really enables us to be successful and, more importantly, remain successful in the long term. So look, I can assure you that anyone who says money management is not important really does not know what they're talking about, and you should really not be listening to them. I have to admit, when I first began trading, all I cared about was where to get in, where to get out, right? I loved chart studies. I still do. And I really used whatever position size I felt like on the day. So very unprofessional. I felt money or risk management techniques were a waste of my time at that point, and could be easily applied later on. Well, that's what I thought. So what is money management? Well, as its name implies, money management is simply the management of your money, your capital or equity in your account. And for the sake of clarity here, money management applies to every single trader, whether you trade with an account of $500 or $5 million. Money management principles should also be applied to both short-term and also long-term trading. Traders may work with what's known as you can see here, a Martingale approach for their money management. Now, just to be clear, I really do not support this kind of approach, largely because it can go very wrong in uninformed hands. But unless there are some who work, but nonetheless, there are some who do actually work with this and appear successful. So the Martingale simply states that as the value of an account is decreasing, the size of subsequent trades, increase by doubling the position size. So if you risk $10 on your first trade, the next trade you lose that, you risk $20 on the next trade, and $40 and $80 and so on. The theory behind doubling the size of your bet is that eventually the losing streak has to come to an end, right? So one of two things will happen: either the streak will end, or you will run out of money completely. Now, do not be fooled. It can really run out quickly. Your account can really be drained very fast if you adopt this kind of trading strategy. Of course, the flip side to a martingale method is an anti-martingale approach, or sometimes referred to as a reverse martingale. And this is what many money management systems are essentially based off of. So as an account increases, the amount at risk placed on future trades also increases. And winners are doubled until a goal is reached. Therefore, it amplifies winning streaks. Of course, traders are free to adjust whether you double up or double up or not. You can go with 1.5 size of the position, of course. So look, fixed fractional strategies, right? So for me, this is what I really do. This is the one I follow, really, to be quite honest with you. Fixed fractional, which I believe was developed by Ralph Vince. Look, if I had to sum up fixed fractional in only just a few sentences or two, it would really be this: risk is kept to a consistent percentage, while the account grows. It grows exponentially due to compounding, right? So, and when you're in a drawdown, the percentage contracts, right? So to help preserve the remaining capital. So look, the fixed fractional method states that for every trade, no more than a predetermined percent of the account balance will be risked. So look, just as a quick example of this, let's say we have, just keep it very, very simple. Let's have a $20,000 account, and I trade according to a fixed fractional method of 1%. So I'm risking 1% on each trade. Now, 20,000 multiplied by 0.01 is $200 on any given trade. And from this, we need to work out our position sizing. As I said, this increases contract size when winning and reduces the risk when losing. Now, guys, this is the hallmark of good position sizing, right? And we finally have what's known as the fixed ratio method. This is another interesting money management approach developed by Ryan Jones. I think it was primarily for the futures and options market. He also wrote a book. I'm trying to think of the name. I think it's called the book, The Trading Game. Look, I'm not too familiar with this method, to be frank, but it's certainly worth mentioning if anyone's interested in this. Then finally, of course, we have the trading approach, right? Our trading setup, our rules for entering and exiting the market. Look, a trading strategy is a plan that employs analysis to identify specific market conditions and price levels. While fundamental analysis can be used to predict price movements, most strategies focus on specific technical approaches. Now, this could be a trend following approach, a momentum-based approach. Now, momentum-based trading is a strategy that seeks to, capitalize on momentum to enter a trend as it's effectively picking up steam, picking up the pace. So, momentum trading is simply the practice of, buying and selling currency pairs according to the recent strength of the price trend. It's essentially based on the idea that if there's enough force behind the move, it will continue to move in the same direction. Look, guys, we also have range trading, which is simply attempting to fade the upper limits and lower limits of that said range. Breakout trading is another one. Breakout trading is a strategy of entering a given trend as early as possible, ready to break out. So with range trading, it's you'll see that price is fluctuating in between a rectangle. If we break out to the upside from that rectangle, well, then we can see we have a potential breakout opportunity. Traders use breakout trading to identify price points that indicate the start of a period of volatility or even a change in market sentiment, right? Yes, so that we also have something called sentiment trading. Look, I won't go into too much detail with this, but sentiment analysis is really that some traders use to try and gain an advantage of what to buy and sell, by reading signals about how other investors are feeling about a particular stock. So for this, we can use the COT report, the Commitment of Traders report, which is released every Friday by the CFTC, the Commodity Futures Trading Commission. Now, this data is based on positions held as of the preceding Tuesday, right? So, which means the data is not real term, but it's certainly still useful. You can also use futures open interest, right? The Forex market is over the counter. Do remember that, with independent brokers and traders all over the world creating a decentralized marketplace. While some brokers publish volume produced by their clients' orders, these are position summaries, and this is another thing you can look at for sentiment. But do bear in mind, it does not compare to the volume or open interest data available from a centralized exchange. Now, open interest, just for those that are unaware, is simply the number of contracts that have yet to be settled and remain open positions. Yes, so this is really all I have to say regarding that. Okay, so these sorry guys, I should have really swapped over here, but this is really the what I was just talking about: the trading strategies, trend following, momentum based strategies, range trading, breakout trading, and sentiment trading. Okay, guys, you've been very, very quiet. So look, if you don't have any questions, any comments or feedback to me, please do send any comments or feedback to the following emails: marketanalyst@fpmarkets.com or support team at fpmarkets.com. As always, look, guys, if there are any specific topics you wish the team here to talk about, please be sure to send in your suggestions to the emails shown here. Look, we have webinars available. We have webinars available to, thank you very much for Dean. I do hope I pronounced your name correctly. So look, for webinars for July, we have basic chart patterns. We have the MACD. We're going to be looking at the MACD, Quasimodo formation, and in July. So basic chart patterns falls in on the 5th of July, MACD on the 12th of July, the Quasimodo formations, there's two parts to this, on the 19th and the 26th of July at the same time, guys. Okay, right. So with that being said, also do make sure to register for our Telegram channel, right? So to get instant updates, the sign up tab can be found in the chat box, or alternatively, if you wish to visit our website, please do that. It's on the lower left part of the FP Markets main website. Just one final check. Okay, fantastic. Look, guys, I hope you enjoyed the presentation. Thank you all for taking the time out of your day, your evening to attend. I really hope you took something from it. Have a great evening, and I'll see you all again soon. Thank you so much.